Hi there and welcome to the BDH Sterling webinar for everything you need to know about pension transfers if you live in Australia and have a UK pension. Joining us today we have John Kinghorn from Equals Money, and John will be talking all things FX with us as we go along. My name is Steph Mills. I'm the Head of Client Services at BDH Sterling. I've worked for BDH Sterling in the UK and in Australia, now working out of Perth at the moment. Joining me today are two of my expat colleagues, so please try and guess the accents if you can. So firstly, I'll introduce Billy. Billy Tomlin is one of our financial planners based over in Sydney. And Billy is has the graduate diploma in financial planning here in Australia. And Billy is also a chartered financial analyst. Joining Billy and myself today, we have Daniel Wentworth is in Perth and is a dual qualified financial planner, meaning that he can give advice both in the UK and in Australia. Hi, Billy. Hi, Dan.
Hi, Steph. Morning, everyone. No, afternoon, everyone, should I say.
Hello, everyone.
Hi there. So joining Billy, Dan and myself today, we have John Kinghorn. So very excited to welcome John on with us today. John has worked in the foreign exchange space for many years, and he's working for Equals Money, who are specialists in the international payments and foreign exchange. Looking forward to hearing your presentation today, John. Hi there, how are you, John?
I'm good, thanks, Steph. Very good, thank you, and great to be on the webinar. Hope everyone's doing well and looking forward to a little discussion today around UK pensions, and obviously I'll be covering the currency exchange rates side of things.
Perfect, thanks for that, John. Okay, so before we get into the presentation, just some housekeeping as we go through the presentation today. So the presentation today will be general in nature. It's really just a high-level overview of some of the topics that might come up if you were looking to transfer your UK pension to Australia. If you were looking to do any of this, then we would encourage you to seek personal advice before you make any of those decisions. The slides will be available after the presentation today. These will be on our BDH Sterling YouTube channel, and we'll also send you a thank you email, which will have the slides in them as well, so you can reference them afterwards. There is opportunity for questions at the end. I will look to answer as many as we can. I've already seen a couple come in, which is great to see, thank you. If you could send these via the Q&A, and not the chat function, that would allow us to get to your question quickly. So let's have a look at today's agenda. As I mentioned there before, we have John Kinghorn from Equals Money, who will be giving us a overview on all things foreign exchange, so very much looking forward to that. Then we'll hand over to Dan and Billy, who will look at the types of UK pensions, why you might look to transfer these. We'll do a section on cure-ops and everything around cure-ops for your information. Then we'll look at the transfer process. We'll also discuss BDH Sterling, and then we'll go on to our Q&A. So goes without saying, I hope you enjoy the presentation today. We look forward to hearing from you afterwards. And if you do have any questions at all, then please do get in touch. But I'll pass over to John for his part in the presentation.
Thanks very much, Steph. And firstly, a big thank you to BDH Sterling for inviting me on the webinar today. It's great to have an opportunity to discuss some of the factors that you may want to consider as you look to move any sort of wealth, pensions or assets overseas. As Steph said, my name is John Kinghorn, and I work for Equals Money, who are part of Equals Group PLC. In terms of a bit of background about me, I've been in the financial services and currency markets sector for nearly 20 years now. A big proportion of that time has been helping individuals firstly make the move over from the UK to Australia. And I've also visited Australia many times, whether it be for work or leisure as well. Obviously, that's been not as frequent due to COVID, but hopefully there's better times in relation to international travel ahead. So I'm very well equipped and experienced in helping expats, and also, as I said, did many sort of get-togethers and forums actually in Australia themselves. So it's a really great to be on this today. In terms of what I'm going to be covering is going to be sort of taking a step back and looking at the pound and Australian dollar. Clearly, those are the relevant currencies for everyone on this webinar. And I think many individuals and banks, and more increasingly so over the last few months, are being underserved by sort of high street banks. So I work for a specialist payments provider, and we'll come on to why you should consider using a specialist if you're looking to move any of your wealth over to Australia or vice versa. So this graph here looks at the pound and Australian dollar over the past 5 years, whether it's the past 5 years, past year, past month, week, or day. The key aspect here that everyone always needs to take into account is the exchange rate is always moving. It can move quite sharply in a given day or week, and that in effect changes or affects the value of any currency transfer that you may need to do. The graph here shows some of the chops and changes over the past 5 years. On the left-hand side, you can see the exchange rate, and on the bottom axis is a timeline. And again, just the purpose here is just to illustrate the movements. And if I had a pound or a cent for every time I've been asked, when is a good time to move my money over the years, I would probably be doing something else at the moment. It's always one of the key questions that comes up, whether I'm doing seminars, speaking to clients, or any discussion around exchange rates. Should I move my money now? Is it a good time? And the only certainty that we've got is that the exchange rate moves. And as an individual, or it could be a business as well, you can look to manage any currency risk by someone monitoring the markets on your behalf and just being aware of the sheer fact of the movements in the exchange rate. And it is worth looking at historical movements as well, just to give you an idea of what the exchange rate has been doing. But ultimately, you can only make a money transfer within the time frame window when you need to make that payment. So again, just to summarize here, this graph just shows that the exchange rate does fluctuate considerably. On to the next slide. Just to take, again, when you're looking at the pound and the Australian dollar, there's some key drivers that affects the respective currencies. So when you look at the Australian dollar, it's a particular impact driver for the Aussie dollar is news or economic data coming out of China. It's a key trading partner for Australia. So what you'll tend to see is if there's some newsworthy data or in relation to a company news coming out of China or the strength of the economy there, that will impact the Australian dollar. And that's usually, if it's positive news for China, that will usually strengthen the Aussie dollar. And conversely, if there's any negativity around the Chinese economy or anything related to companies there, that may weaken the Australian dollar. In addition to China, commodity prices as well can impact the Australian dollar. So whether the prices is remaining stable or strong, that can benefit or strengthen the Australian dollar. And conversely, if commodity prices are weaker or under pressure, that can weaken the Aussie dollar. And again, in addition to those two key drivers, any economic news clearly coming out of Australia, GDP figures, unemployment, business, consumer confidence, interest rate rises, those type of economic data announcements and news can impact the Aussie dollar. On the other hand, for the pound, and what we've seen recently for both currencies, has actually been quite a lot of negativity recently. And it's been a case of seeing which negativity comes to the top of the pile in terms of the news stories. And the Aussie has been under a bit of pressure in recent months. So if we just look at the past 12 months, so the past year period, the pound is 3.5% higher than the Australian dollar than this time 12 months ago. Over the course of this year, so 2021, the pound is 5.5% higher. So what does that mean to you? Well, it means if you were looking to move any money over, is that you're going to be getting more Australian dollars for your pounds just due to those movements in the exchange rate. Just to give a bit of reasoning or rationale why there's been these pressures on the Aussie dollar, is that it is a tale predominantly of two vaccine programs. The UK was actually very quick and organised in relation to its vaccine rollout, and on the other side, Australia were a bit slower off the mark, and we're still seeing some lockdowns in areas of Australia. However, even this week, we're seeing more optimistic noises and sound bites around Australia. Obviously, restrictions being eased in the majority of the country, therefore things will open up, which will have an impact, bounce, and potentially strengthen the Aussie dollar over the months ahead. So that's the last 12 months. Just to look ahead, so as we discuss things now, and just with the information that we've got in front of us, there's a lot of repetition on currency and news in the UK at the moment around winter of discontent. There is the news cycles on repeat in relation to energy prices being soaring high, which in effect for a proportion of people can make the cost of living more expensive as we come into the winter months. There's also the end of the furlough scheme here in the UK, the government-backed furlough scheme. And obviously there's a bit of uncertainty around COVID, winter, pressure on the NHS. So all these buzzwords, which I said the media is not being short of repeating, it could cause some negativity and weakness for the pound, and it will be a case of waiting and seeing what the true picture of the economy is, and over the next few months that will become clearer. On the other hand, Australia, the Chinese, there was some issues in relation to Evergrande, who's a bit of a large business in China, and those issues or problems that were faced or encountered there led to some weakness in the Aussie dollar. Those potentially could subside over the next few weeks and months, again, leading to a stronger, more healthy situation in the Chinese economy, which again would boost the Australian dollar. We did speak with our internal chief economist and market analyst. And again, this is just with the information we've got at the moment, and things can change and things can change quickly. Sort of our views at the moment in terms of predictions, looking at the pound and the Australian dollar over the next 6 months, looks at around 1.83, that rate in the next 6 months. And looking at the next year, again, potentially the pound Australian dollar rate looking at 1.81. But as I said, that's just based on the information that's out in the public domain at the moment. I'll cover the next slide, please. So international payments. So if you're looking to move any money at any point, whether that's pension, wealth, assets, anything at all, really, it is worth considering using a specialist company as opposed to your local bank, whether that's your bank in Australia or the UK. Banks don't focus or specialize in helping their customers move money abroad. A specialist company will help you ultimately get more Australian dollars for your pounds by firstly offering typically a much better exchange rate. So that can be up to 4% better than what your bank will offer you. But just as important as that exchange rate that you're offered, it's the currency management and guidance element, which is really key. As I highlighted earlier on, when you move your money, whether it's within a week, day, month, or a year, is the most important factor. There can be swings of 3 to 4 to 5% or even higher in the exchange rate. That in turn changes the value of your currency transfer. So it's really important you're receiving guidance from a qualified expert who can let you know what's going on with the currency at the moment, so the pound and the Australian dollar, and looking ahead, what are the type of things, whether it's economic announcements, COVID, interest rate potential rises, this type of news can impact the rate. And there's different ways you can manage your risk when moving money overseas. So that could be locking into exchange rates for a period of time, or we can set alerts as well, just to notify you when there's any movements in the rate. And you may decide to move some of your money at that time, or you may decide to hold off, or you may decide to move all of your money, again, depending on what that move and what that financial implication and impact looks like. Just another point about using a specialist company as opposed to your bank. In essence, it's the same process as using your bank, because your funds, any client funds, are held in safeguarded accounts. So Equals Group has banking partners such as Citibank, Barclays, and Royal Bank of Scotland. So if you're to make any money transfers abroad, your funds sit in a safeguarded, segregated client account, which can't be touched by that specialist currency company. Just to move on, again, I just wanted to provide a high-level overview of currency, the pound, Australian dollar, where we're at now, and things to look ahead to, really, over the next few months. Just some background about Equals Group PLC. So Equals Group are listed in the London Stock Exchange and have helped over 1 million customers move money since 2007. We're authorized by the FCA and regulated by HMRC. We've been around for a long time, and we do help a lot of individuals in the situation, or who are looking to move pensions or any wealth abroad. So if you would like any further information, there's obviously some questions at the end, which so feel free to ask anything, but more than happy to have a chat about your individual requirements and see how we can help you maximize any currency transfers. And my contact details are on the slide here, or feel free to reach out to the BDH team and they can put you in touch with me. So again, that was just meant to be high level. I hope you found it useful, and I'll now pass you back to Steph. Thank you.
Thank you, John. That was very insightful indeed, and pleasure to have you on with us. So thanks for that. Yes, please do stick around for questions at the end. And if any of you have questions for John, please pop them in the Q&A, and we will look to get those to him at the end of the webinar. Okay, so the first section from the BDH guys is the types of pensions and wire transfer. So this one is over to you, Dan.
Okay, thanks, Steph. Afternoon, everyone. So yes, today I'm going to be running through the types of pensions that people have in the UK, and what can and cannot be transferred. So first of all, you can see here on the left of our slide, we have the types of pensions that can indeed be transferred across from the UK to Australia. And firstly, we have company pensions, which you may have accumulated from your time working from your previous employer whilst in the UK. And I will touch upon on the next slide the difference between the two different types of company pensions that people can hold back in the UK. Another type of pension that can be transferred is indeed a private personal pension. It may have been that when you're in the UK, you may have been self-employed and as a result, built up your own UK pension entitlements whilst working there. These can also be transferred across to Australia should you choose to explore that option. And finally, the other type of pension that can be transferred across to Australia are funded public sector defined benefit schemes. Now, the significance here is that funded component. So typically, the only public sector defined benefit schemes that can be transferred are local government pension schemes. So if you worked for your local council in the UK, and this is because there is a pool of money there that it can be offered as a capital lump sum for you to transfer out of. Moving on to the schemes that unfortunately cannot be transferred. First of all, we have the UK state pension. Typically, if you were working in the UK, you would have been making national insurance contributions whilst you were working there and building up entitlements to the UK state pension, which is paid to you by the government in the UK. Now, this is paid on a regular basis, i.e. weekly, to yourselves once you reach the UK state pension age, but cannot be transferred away as a capital lump sum. You will just continue to receive that income from the government in the UK should you have built up entitlements back there. The other type of schemes that cannot be transferred include government unfunded pension schemes such as the NHS, the Army, the police force, or the the fire services in the UK. Now, the reason for this is because these schemes are unfunded. It is actually, in fact, the current members who are effectively paying for those that are already in retirements and receiving the pension schemes, receiving their pension from these schemes. So there is no pool of money as such that can be capitalised to transfer out. You can transfer within this select group of pension schemes in the UK. So if you were to be working as a nurse, for instance, for the NHS, and then went and worked for the army, you could potentially move your scheme between one and the other, but you cannot move it out of this select group of pension schemes in the UK. The other types of pension schemes that cannot be transferred are those company pension schemes that are now within what's known as the Pension Protection Fund in the UK, or as colloquially known, the PPF. The reason for this is the scheme may have fallen into administration and unable to afford the payments for you as members, and therefore the independent company, the PPF, has now absorbed the liabilities and is paying that pension out and is unable to again provide a capital value for you to transfer those funds as a lump sum across to Australia. Additionally, you are unable to transfer across company pension schemes that are already in payment, and you are the same as well for annuities that have been purchased with a life insurance company in the UK. So the next slide I just want to go into is just provide a bit more of a definition of the two different types of company pension schemes you will have in the UK. So firstly, I'm just going to talk a little bit about defined contribution pension schemes. Now, these are very similar to your stereotypical super funds here in Australia, whereby contributions are made by yourself as a member and also by your employer into the defined contribution scheme in the UK whilst you're working there. And the value is determined by the contributions made by you and your employer, and then the investment returns or growth that is achieved as a result of those contributions that were made whilst you were working back in the UK. The other type of pension scheme in the UK, or company pension scheme, is a defined benefit pension. Now, these are based upon your final salary at the time of you leaving your employment with that employer in the UK and the number of years that you worked for that employer. Now, there is then a formula that is in place within these schemes which determines how much these types of pension schemes are going to pay to you on an annual basis once you reach the scheme's normal retirement age. So as you can see, these are valued as a per annum amount, and they don't actually have a capital value unless you request what's known as a cash equivalent transfer value, should you be exploring the option of potentially transferring away from that defined benefit scheme. So now I want to come on to discuss the reasons why you may look to consider transferring your UK pension scheme across to Australia. And obviously the first point you can see here is quite topical given John's discussion he's already shown today. It is that currency consideration. If we were to keep these UK pension schemes where they are, then you are going to be subject to currency risk throughout your retirement. Whereas the option of transferring these funds across to Australia allows you to potentially convert those funds into Australian dollars and remove the long-term currency risk that you could be exposed to should you retain the UK pension schemes back there. The other considerations include the estate planning. So typically with company defined benefit pension schemes in the UK, only 50% of the income that you will be eligible to receive will be payable to your spouse in the event of your death. And then if your spouse is to then follow you and decease themselves, then nothing will pass on to any other beneficiaries or your estate unless your children are in full-time education and under the age of 23. But again, that is dependent on the scheme rules. But typically, it is only your spouse who can benefit through the estate and receive that spouse's pension, and nothing is then able to be passed on to your other estate, unlike potentially having the funds here in Australian Super, and we'll come on to discuss that later on. The other consideration is if your scheme, especially again with defined benefit pensions, if there is a scheme funding deficit. So as we've mentioned, if your scheme is underfunded or falls into administration, then your pension may be payable to you from the Pension Protection Fund or the PPF. And there is a cap typically, which is 90% of the eligible income you should have received had your scheme not fallen into the Pension Protection Fund. So it's something else to be wary of and consider when reviewing the possibility of a transfer. The other considerations include being able to take investment control. It may be, well, would be that your current UK pension scheme, you are not having much input into how those funds are invested, and this is being controlled by the trustees of the current pension scheme. And you may not be happy with how the funds are being invested, because it may not align with your attitude to risk, or the returns that the fund is generating do not align with your retirement objectives. Therefore, reviewing the possibility to transfer out can provide you with the opportunity to try and align how the funds are invested with your attitude to risk, and hopefully try and achieve those returns more in line with your retirement objectives overall. Now, another consideration is the tax treatment of these benefits should a transfer be undertaken. So, as you all may be aware, with an Australian super fund, you pay tax on the contributions on the way in, but when you start taking income from super, once you've met a full condition of release, then that income is a non-assessable tax-free income in retirement for you, which is a major benefit of the Australian super system. Now, with a UK pension, it is the reverse, and therefore, if you do retain your pensions in the UK and take an income from those, then the income will be added to your worldwide taxable income here in Australia and taxed at your marginal tax rates here. Therefore, if you did look at a transfer, you could look at benefiting from the Australian super tax system of having that non-assessable tax-free income in retirement by bringing the funds here. But unfortunately, as we all know, there are two certainties in life. There is death and taxes. So if you were to go ahead and transfer your funds across to Australia, there will be tax on that transfer, and that will be dependent upon the amount of growth your funds has achieved since your date of arrival here in Australia. And that's something that an advisor such as ourselves could be able to assist you in calculating and reviewing whether that's going to be worthwhile for you or not when it comes to a transfer. And finally, another reason to consider potentially transferring is the ability to look at consolidating all your retirement funds in one super or pension vehicle. So it may be that you'd look to do so to reduce your overall fees or try and compound your returns that you may wish to achieve to assist you in meeting your overall retirement objectives. Now, with anything, there are potentially disadvantages to looking at transfer, or reasons why it may not be the best option for you. So the first being, it may not actually be the most cost-effective or even tax-effective avenue for you to explore. It could be that the current pension scheme's fees are very, very affordable and the returns are very good. And actually, because you have no other taxable income, it's going to prove to be tax effective for you to take that income directly from the UK rather than pay tax on the transfer or incur the fees involved with the transfer. Again, that's something we can help you determine. It may be, as I just mentioned, that the current UK pension scheme is providing good returns. With a defined contribution scheme, the investments may be performing very well, or with a defined benefit pension scheme, some of these schemes provide guaranteed fixed rates of escalation and revaluation, and therefore it may be in your best interest to keep those benefits for your retirement. It could also be that if you were to transfer away before your retirement age, there could be an early exit penalty or a market value reduction applied to those benefits should you wish to undertake a transfer. So therefore, this is going to be a major consideration for you if you do wish to bring those funds across to Australia. And finally, if you hold a defined benefit pension scheme, currently all the investment risk is based on the employer rather than yourselves as a member. And it may be that actually transferring out of that scheme and then having the investment risk rest with yourself, you may not be comfortable with that. And therefore retaining it with the employer may be in your best interest moving forward. So I just want to look at, now that we've discussed the types of pensions and the reasons why you'd potentially look at a transfer or why not, we just want to just clarify what the transfer options are. Now, you may or may not be aware, but under current legislation, you need to be over the age of 55 to bring your funds across to Australia. And Billy will touch upon this further later on in the presentation. So we just want to outline the transfer options for both those under the age of 55 and for those over the age of 55. So first of all, if you are under the age of 55 currently, there are two options. One is that we could potentially look at transferring your UK pension into an alternative UK pension scheme, such as a UK self-invested personal pension, or a SIP, as they're otherwise known, or you could look at a private pension in the UK, such as a personal pension plan, to explore transferring those funds into. The alternative option is that actually leaving the funds in the current scheme may be in your best interest for the reasons that we just discussed on the previous slide. Now, the reason why we would potentially look at transferring your funds to a UK SIP is because that these personal pensions allow you as individuals to have input into the investments decisions around these funds moving forward. So colloquially, we would say that these are relatively similar to a self-managed super fund here in Australia, for those that you are familiar with that super product here. And you can also appoint a third-party advisor, such as ourselves, to assist you with the management of those funds if you don't feel competent in managing the investments solely yourself. But it gives you that option either way. And then I want to just talk about the transfer options for over 55, please, Steph. Oh, sorry, the benefits of that SIP as well. Sorry, just skip a slide. So with regards to the SIP option, the reason being and why we potentially look at doing that prior to age 55 is because it does provide you a bit more currency control in terms of having your funds denominated in British pounds or Australian dollars prior to the eventual transfer itself. And secondly, it allows you to even invest potentially in British pounds or Australian dollars, whereas most company pension schemes you will have to hold your funds in British pounds and invest in British pounds, keeping you exposed to that currency risk in the future. The other benefits of a SIP in the UK is that 100% of the pension passes to your beneficiaries if you pass away under the age of 75. And you can have as much input as you choose to do so with regards to the investment of those funds, as we previously mentioned on the previous slide. So for those that are over the age of 55, then we have another option, which is potentially transferring the funds across to Australia. And for those of you that have done a bit of reading online, you may be familiar with the anagram QROPS, which stands for a Qualifying Recognised Overseas Pension Scheme, which Billy is going to come on to discuss in much more detail. And you could potentially explore transferring your UK pension scheme across to one of these QROPS super funds here, in line with the non-concessional contribution limits here in Australia. Alternatively, again, you could consider leaving your pension in the UK and within its current scheme, should you choose to do so. Perfect. So I'll pass you across to Billy now to run through QROPS and the rules and legislations surrounding these funds.
Thanks, Dan, and hi, everyone. As Steph mentioned, I'm Billy Tomlin, so I'm a financial advisor here at BDH. I assist clients with UK pension transfers, along with holistic financial planning as well, such as retirement investment strategies. So yes, I'm here to discuss QROPS, which, as Dan mentioned, I'm sure you would have come across if you've started looking at the option of transferring your UK pension over to Australia. So hopefully just to provide a bit more information, a bit of context, and really where it fits in and why it's needed in terms of transferring your funds over to Australia. So firstly, a QROPS is a qualifying recognised overseas pension scheme, and this was introduced back in April 2006 by the UK government, and really it was for the framework for transferring a UK pension outside of the UK. Prior to this, it was extremely difficult to do so, so this provided the rules and regulations for transferring out of the UK. So QROPS itself is not a product, but a product or a fund can be known as QROPS compliant, providing it meets certain rules and requirements set out by HMRC. And really, if you've got UK pension, if you've accumulated UK pension over in the UK and you're retiring elsewhere, a QROPS is your only real option in terms of transferring that out or retaining the fund in the UK and accessing it that way. So as you can imagine, since 2006, there's been quite a few legislation changes. And dealing with both Australia and the UK, certain rules and regulations that change can affect the UK pension transfer space. So as Dan mentioned, you can no longer transfer out of unfunded government schemes, such as NHS, police pension, etc. Probably the biggest change I've seen in the QROPS space was the introduction to the pension age test. So again, back in 2015, the UK government changed. So you can basically now only access your UK pension before the age of 55 if you're terminally ill or in serious ill health. Now, you can also do that with your Australian super fund, but there are other early accesses such as being in financial hardship or going bankrupt. So prior to that, the majority of super funds over here were considered CUROPS compliant, but because they have that early access before 55, since that rule change, that knocked off all of the funds being CUROPS compliant. So as you can see, over 1,600 super funds over here were knocked off. They're no longer CUROPS. And now your only options, there's two options. So a CUROPS self-managed super fund, or a CUROPS retail fund known as Aesf, which is the Australian Expatriate Super Fund. So they both only allow members that are 55 or older, and that's why they're seen as CUROPS compliant. Now, just so you're aware, it's not legislation yet, but there are talks of that age being increased by 2028 to 57. So it's not legislation yet, it's still 55, but there are talks of that being increased, as I say, to 57. Now, also another rule change in 2015 was the need to get financial advice for defined benefit schemes that are over £30,000. So you must receive independent financial advice prior to transferring over. The scheme itself won't transfer if your transfer value is above that amount and you haven't received that advice. And again, really, that was just so members with the defined benefit schemes knew what the guarantees were, knew what the benefits, disadvantages of moving out. So in 2017, there was another change. This was to do with the overseas transfer charge. So now you can only set up and transfer to a CUROPS fund in the same jurisdiction that you're a resident of. And that sort of knocked off the strategy of moving or setting up a CUROPS into favourable tax jurisdictions such as Guernsey and Malta. So if you are a resident of Australia and you set up a CUROPS in Australia, that's fine. You just can't set up a CUROPS in a jurisdiction, as I say, that you're not a resident of. If you do so, there is a tax charge, and that tax charge is 25% of the funds transferred in. In July 2017, there was a change from the Australian perspective, and this is to do with the non-concessional cap. So in terms of transferring over to Australia, there's two components. Dan mentioned that the taxable component, which is the applicable fund earnings. The other component is the tax-free contribution known as non-concessionals. Now, before 2017, what your annual cap was $180,000. You could use what's known as your bring forward provision, which is an additional 2 financial years worth. So effectively, you could bring over $540,000 as a non-concessional contribution. Now that was reduced, as I say, in July 2017 to $100,000 per annum, or utilising your bring forward provisions, $300,000. And now that has changed from this year, July 2021. It's moved in line with inflation. So it is now $110,000 per annum, or utilising your bring forward, $330,000 as a non-concessional. So the benefits of a CUROPS, and really as this is the only option in terms of transferring over to Australia, they sort of fall broadly in line with the benefits of transferring your UK pension. So having your pension in the same country as yourself, not dealing with, specifically in the UK, time zones, you can have someone in there looking after your fund that you can get on the phone with and speak to them in the same day, as opposed to waiting overnight or whatnot if the funds were still in the UK. Within a CUROPS fund, you can hold the funds both in GBP or AUD and run an investment strategy, again, both in both currencies. Again, Dan mentioned with defined benefit schemes that the 50% spousal pension, if you were to come out of that, bring it over to a CUROPS, it then falls in line with super rules in terms of 100% of that can be passed over to your beneficiaries. In terms of the tax treatments, again, very similar to what the super rules are over here. When you convert the fund into pension phase, the fund becomes tax-free, and that's in terms of all capital gains, all distributions, all dividends within the fund, and also the pension payments that you take from the fund would also be tax-free. And finally, in terms of the CUROPS, you could consolidate all the funds into a CUROPS. So when I say that, I mean you could set up a CUROPS, bring the UK pension across, and then you can also transfer your current Australian super into that fund as well. If you actually have an SMSF, a CureOps SMSF, and both you and your spouse are over 55 and have pensions, you both could become members of that fund and transfer it all into the one vehicle along with your Australian super, and that can be very effective. The administration for the SMSF is fixed costs, so works on the economies of scale basis. The more money that you get into that fund, the more cheaper it is on a percentage basis. So CureOps responsibility. So these really fall on both the member and the administrator of the fund. So firstly, there are reporting requirements from transfer. So that's 10 years. And these are certain trigger events that need to be reported back to HMRC. So for example, it could be a change of address, or starting of pension payments. Those sort of, as I say, trigger events need to be reported back to HMRC. Then you've got the member payment provision period, which is different from the reporting requirements, and that's the longer of 10 full UK tax years of non-UK residency. The longer of that, or 5 years of from the transfer again of UK tax years. And it's really important that you comply with these rules. If not, you would be subject to what's known as an unauthorized payment charge, and the tax charge can be up to 55% for breaking these rules. The main rules really is moving out of a CureOps fund within that time frame, or investing in certain assets that are defined by HMRC, which are not allowed. So the biggest one would be residential property, so direct residential property. So you can invest in direct residential property within an SMSF, but with a CureOps SMSF, you simply can't without incurring this charge. The reason being is that you can't invest in residential property within a UK pension fund. There are other sort of assets, such as collectibles, antiques. Again, they can't be purchased within a CureOps fund, either the SMSF or Aesf. Okay, I'll pass you back over to Dan. He's going to briefly discuss the transfer process.
Thanks, Billy. So now I want to just touch upon the BDH Sterling transfer process. Should you have a UK pension and wish to potentially contact us to look at reviewing this UK pension and the possibility of transferring those funds across to Australia. So the first port of call I would recommend is contact us for an initial appointment. So this is no cost for yourself and there's no obligation following the initial appointment. Obviously, we do like to conduct those face-to-face, lockdown and state restrictions pending, of course, at this point in time. And then if we can't, we can always do it over video phone call, whichever suits you best. And the purpose of the initial meeting really is to understand your situation and your objectives concerning your UK pensions and your holistic retirement planning goals. And then we can provide you with an introduction into our service, our fees, and determine between us if this service is going to be of value to you moving forward from that first meeting. Should you then choose to go ahead with regards to engaging us, we would then begin our research and review your options as regards to this UK pension. So we will consolidate and compile all the information that we can obtain about your UK pension schemes and yourself, and then we would compile that into what's known as a UK pension transfer analysis report, which we will then present to yourself, completing a full review of your situation and your UK pensions. And at the end of that document, we will include our recommendations of advice as to how we best feel that you should proceed. And we can then sit down to review that report and discuss any queries you may have, discuss why we've given those recommendations, and ultimately run through what would be the next steps pending what our recommendations are at the end of that pension transfer analysis report. What I would say as well, that report will include commentary on the current legislation and regulations that we need to be aware of. We would include in there our research and analysis so that you've got full visibility of the information surrounding your scheme, and so you can understand by the time you're reading our recommendations why we've reached those conclusions. And then finally, should we recommend a transfer for yourselves? and we then proceed, you can then engage us to undertake the transfer itself of your UK pension funds. Typically, we would place them consolidate them into a temporary product in the UK before transferring them across to Australia, should you be over the age of 55. And we can manage that transfer process from beginning to end in the UK, all the way across here to Australia, and then assist you with the ongoing management of those funds. Now, I just want to touch upon some of the reasons why we think that obviously seeking advice is going to be in your best interest before making any decision as to whether transferring these schemes is going to be in your best interest or not. And the first one is the fact that, as you can see from what Billy's mentioned earlier on in this presentation, there are constant tax and super changes in the UK and Australia. Obviously, we're dealing with two jurisdictions here, and we're looking at exploring the possibility of transferring a UK pension across to Australia. So I would certainly recommend dealing with someone who's a specialist in this area. It is very niche, and you do not want to be caught out by any of these regulations, because, as Billy has indicated earlier, there are some very high penalty charges that you could be faced with, which you can see as the next bullet point. If there is anything that you conduct wrong in that transfer, then there can be penalties up to 55% of the fund value, which apply to non-compliant transfers. So it really is important that you do undertake the correct steps, and that's why we certainly feel obtaining this specialist advice is essential. And finally, it may be that you're confirming that the pension transfer itself is the best option for you. Obviously, the last thing we want to hear is that you've undertaken a transfer and then later on in life it turns out that actually it wasn't the most suitable option, because you've done that upon yourself. Hopefully by engaging a financial advisor and specialists such as ourselves, we can eradicate those scenarios taking place, and because we're going to be outlining everything for yourselves, so you've got that comprehensive overview before making an informed decision as to whether a transfer is going to be in your best interest or not. Perfect. So I'll pass you back over to Billy just to run through a little bit more on BDH Sterling.
Thanks, Dan. So first and foremost, BDH are duly licensed advisors. So we're regulated and licensed both in the UK and in Australia. And really, it is imperative that if you are a resident of Australia, that you do get advice for people that are licensed in both jurisdictions. What I would say is, even if you don't utilise BDH, go to someone that have got both the licenses. What I've seen is people offshore that have been solicited and then get advice from some of these pension providers, and they simply do not act in the client's best interest, is the kindest way I can put it. So just make sure that licensed and regulated, both in the UK and Australia. And what that means really is that we can do everything under one roof. You'd get an advisor that can speak you through the whole process, so from the UK all the way to Australia. And what we can do as well is also provide that ongoing Australian advice. So as I mentioned with the CUROPS, the administration is both on the scheme administrator and the member. So we've got a service that we can ensure that you comply with all the relevant rules, keep you on top of all the rules and regulations to ensure the CUROPS remains compliant, so you don't get hit by any of these nasty tax charges. We're also defined benefit specialists. So as I mentioned with the defined benefit schemes, you do require independent advice from a pension transfer specialist that we've got within the company. So all the defined benefit advice that you would receive would be from BDH. So again, I've seen other pension providers that will outsource that part, mainly because they can't provide the advice. So again, all in-house within BDH Sterling, and all done under the one roof. As mentioned, so we are financial planners as well, so we can help with Australian super strategies, contribution strategies, retirement strategies. We also have risk specialists, so we can help with reviewing insurances and also get a retirement plan, a capital sufficiency analysis report to model, when do you want to retire, how much do you want to retire on, have you got enough assets to do that, or do we need to put strategies in place to sort of bridge that gap? We also work quite closely with BDH Tax. and they're chartered in both the UK and Australia. So if you have any specific tax advice or UK assets, such as property whilst resident in Australia, and you need help with tax returns, we are happy to refer you over. And again, can all be done under the one roof. So we have got 15 years of experience in UK pension transfers. So fully across it, we're very specialised. We know what we're talking about. So yes, please feel free to get in touch. I believe on the next page there is the inquiries. So feel free to email us at that address there. If you could provide some bits of information on what your circumstances are, we'll be able to get the relevant person to come and talk to you and have that initial talk, just to see if it is something that we can help with and advise on.
Perfect. Thanks for that, Billy and Dan. That was really great to go through all of those topics. So yeah, the next section is the Q&A. We actually have run over time a little bit, but we are going to answer as many questions as we can. There's quite a lot that have come through. So please do stick around if you'd like to hear those right now. Otherwise, as I said before, they'll be available on the recordings that will be posted out after the webinar as well, if you're a bit stuck on time today. So I'll just go through the questions. If you just bear with me, sorry, we'll just have a look here. Okay, so question for you, Billy. What are the advantages and disadvantages of comparing an Smsf with Aesf?
Yes, so Aesf and Smsf. So it is specific for client circumstances, but what I can give you is a very high level view or a general view of how we look at it. Aesf, their administration cost works on a percentage basis, whereas the SMSF is on a fixed cost. So as you can imagine, with the higher balances, if the more funds are in the SMSF, the cheaper it becomes. Aesf becomes more suitable for those with smaller balances. That being said, you may not feel comfortable having an SMSF and may want an Aesf as an alternative. So it will be specific for the client circumstances, but as a general rule, the higher the pension value, the more appropriate the corrupt SMSF becomes.
Okay, thanks for that. John, I've got a couple of questions here for you. So let me just have a look at the first one. Are the segregated client money accounts protected only in the UK? Or are there any currencies ever held outside of the UK? And if so, how are they protected?
Yeah, well, in the example, any client who sends us their funds, they will be held in a segregated, safeguarded account. In the example of someone moving money from the UK to Australia, as obviously quite relevant for everyone on here, they would send their funds, their pounds sterling, whatever amount that is, that would come to our safeguarded client account, which we can't touch as a business. And then thereafter, we make the currency conversion to their bank account, nominated bank account in Australia or wherever it is in the world. So in the example, we don't need to hold funds overseas because we make the conversion to the bank account of that individual in that country, and whether it be Australia or wherever it is. But yeah, we're regulated. But the regulations mean that we need to hold funds in safeguarded and segregated accounts, so we can't touch that money effectively.
Perfect, thanks for that. Okay, Dan, question for you. What are the implications if I am 64 today and I transfer my defined contribution scheme within the next 6 months and my selected retirement age is 65?
Yeah, absolutely. So yeah, you can certainly look at transferring that pension fund across to Australia, and we'd have to look at the scheme rules to see if there is any early exit penalties, etc. Given if the scheme age is 65, as you've mentioned, but under current legislation, you should be able to look at transferring those funds across to Australia. It would just be worthwhile noting that if you do undertake the transfer after the age of 65, there could be bring forward rule issues with the non-concessional contribution cap to be wary of, but that's something that we can explore with you specifically should you wish to get in touch.
Perfect, thank you. Billy, one for you here. I have a pension that I can take in full now. What are the tax implications for this? The pension is in the UK and I live in Australia.
Okay, so accessing a UK pension from Australia, the income from that pension would be taxable. And it would be taxed or would be added to any of the assessable income that you've got, and then taxed at your marginal rates here in Australia. So really the two systems work in the opposite way around. In the UK, in the accumulation phase, it's tax-free, and when you access the pension in retirement, it is taxable. If you're in Australia, as you know, contributions and capital gains in the accumulation are taxed at 15%, but then in retirement phase, the fund becomes tax-free. So if you're a resident in Australia and access your UK pension, that income would be taxable here in Australia, as I said, added to any other assessable income and then taxed at your marginal rate in Australia.
Thanks, Billy. There's a couple of questions here on unfunded schemes. One is a teacher scheme and one is ex-defense, so armed forces scheme. Yeah, these are both schemes that, as Daniel explained in the webinar, you are not able to transfer anymore post 2015. Actually, I think that was Billy, my apologies. But yes, you cannot transfer those types of schemes out of their current place anymore. Question here for you, Dan. Once I move my pensions to Oz, for the purposes of pension laws, how long may I spend in the UK each year and still be regarded as a resident in Australia?
Yeah, so it's a very good question. It's an important point to note. So you do want to ensure that you're not becoming a UK tax resident at any point whilst you have a CUROPS superannuation fund here in Australia. Because if you are deemed to be a UK tax resident, then you would be faced with that overseas tax charge that Billy mentioned that was introduced in 2017 and potentially face 25% tax charge. So it is worth noting you would need to ensure that you're not spending longer in the UK than 6 months without working. And if you do work in the UK, then that potentially could cause an overseas tax charge issue for yourself if you've undertaken a transfer to a CUROPS fund here and that CUROPS still be active.
Okay, thank you, Dan. John, one for you. Is there a time of the month or year where the exchange rate is higher than normal? I've previously experienced it is better to exchange dollars early in the month to achieve a more favorable rate.
Good question. The timing is the most important factor when moving your money. However, it's not usually based on the time in the month as such. It's based on news that's coming out, whether it's from the UK, Australia, China, whether that's economic news, could be related to COVID, lockdowns, restrictions, interest rate rises. That type of news and data announcements, whether it's political or economic events, would impact the exchange rate. So it's really important that the exchange rate's getting monitored on your behalf, and it's important to speak to a specialist. I think the key themes throughout the sort of presentations today is to have that initial conversation with an expert in their respective field to help you avoid any expensive mistakes. So yeah, the timing aspect of a currency transfer is not down to seasonality or the time of the month, it's down to those political and economic factors.
Thanks, John. Billy, one here for you. Are established Australian super funds, e.g. Australian super CUROPS compliant? If not, can you consolidate a CUROPS fund with your existing super fund?
Yeah, so yeah, since 2015 with the pension age test, as I mentioned, the majority of Australian supers are no longer CUROPS compliant. So it is only those two funds now, the CUROPS SMSF or the one retail fund known as Aesf. In terms of the consolidation, so you can consolidate your existing super fund into the CUROPS, but you couldn't do it the other way around within the member payment provision period. So yes, you can do it after that period, but before that, you can only consolidate your Australian super into the CUROPS.
Thanks, Billy. Dan, one for you. This one is a very hard one to answer, but I'll let you deal with it. So how long does the process take to transfer from a SIP to an SMSF?
Yeah, it's a very difficult one to answer conclusively. And what I would say is it's going to depend on where you are at in the process and whether the CUROPS self-managed super fund is already set up here in Australia. Otherwise, that is going to add a time lag to that process. But if you're in that position of having the funds prepared at both ends and the funds sat in the SIP ready to come across, then the UK SIP provider needs to complete a lifetime allowance test to see what percentage of the UK lifetime allowance the transfer is going to be using up. Once they've completed that calculation, they then need to conduct their own verification on the CUROPS fund to confirm that it meets the requirements before they can then transfer out. So yeah, unfortunately, I'm going to have to answer that. That's a bit of a how long's a piece of string type of question, I'm afraid, and can't really give a definitive answer, but hopefully it just gives you an understanding in terms of what's going on in the background before that SIP provider can make the transfer.
Thanks, Dan. Yeah, not an easy one to give an answer on. John, one here for you. Would it be possible to have the money invested in either a SIP or an SMSF or both, and then forward trade them?
I think in terms of the pension or the SIP side of it, it may be better Billy or Dan's side, Dan, to give a view on that. But if there is potential to fix rates and things like that, there can obviously be benefits of doing so. We do usually work quite closely with the BDH team in sort of parallel to make sure that the maximization of any fund transfer is achieved. So again, something we can look at with the BDH team, and so we certainly are keeping a very close eye on that rate.
Thanks, John. Yeah, just to add to that, so when funds are in a UK SIP, to forward trade them, they largely need to be in cash or cash products, so they can't be invested. That is the rules of the SIP providers based on the liability that they take on for doing these transactions on behalf of our clients. But you can do forward contracts and trades, but they do need to be on cash monies. Okay, Billy, how do we keep UK bank accounts going when most accounts require a UK address, e.g. replacement of debit and credit cards, etc.?
Well, I wouldn't want to give an answer to that one. I'm not entirely sure, to be honest with you there. I'm not sure.
I can just jump in and just say what can be done is that you can look at actually establishing a GBP account with some other brokerage, with some of these online brokerage firms these days here in Australia. So if you did have having issues in terms of maintaining a UK bank account, which I know many expats do, then potentially that could be another avenue for you to explore.
Yeah, thanks for that, both. Okay. Billy, one for you here. How much do you need to have in your UK pension fund to make establishing an SMSF in Australia worthwhile, given the cost of setup and administration?
Yes, again, I guess the basic rule we work off is $300,000. But again, it will be specific to the client's circumstances. So if you've got other super funds over here and you can consolidate, that may be an option. But as a general rule, around about the $300,000 mark is where we see as the cutoff point. Anything under that, the Aesf would likely be the better option. But again, all specific. So if that was the case, let's have a chat and we can discuss in a bit more detail. But to confirm, around about the $300,000 mark, anything above that, SMSF's more viable. Anything below that, the Aesf fund is more viable.
Thank you. And Dan, one here for you. Is it still the case that there is only one CUROPS in Australia recognised by the HMRC?
Well, yeah, there's just the one retail fund, but as we've mentioned and as Billy introduced earlier, there are the two options and the avenues to explore. You've got the CUROPS SMSF option or just the one retail fund, which is the Australian Expatriate Super Fund as discussed.
Thank you. I'm just picking up a couple more questions in the chat function. So just bear with me. Billy, there's one here. I have 3 pensions. Should I merge them before I transfer?
So again, it will depend. So as part of our service, we would provide advice on all 3. It may be the case that one of the schemes it's not worth transferring over to Australia. If so, then leave it in there. But if the case is to transfer over, then it would be worthwhile consolidating first in the UK and then transferring to Australia. There's certain reasons to do. I won't go again, more specific advice, but it's certainly worth getting advice on all 3 pensions. And as I said, the main strategy would be to consolidate them first and then look to transfer over to Australia.
Thank you, Billy. Okay, so the final question here, one for you, Dan. You mentioned there may be a tax on transfer and depending on how long you've been resident in Australia, but yet you can't set up a QROPS until you're resident. Does this mean you should transfer shortly after your arrival in Australia if you are not currently living there?
Yeah, so as a general rule, it can work out to be more tax effective in transferring shortly after your arrival here in Australia. And as you've correctly identified, it's not possible to do so prior to arriving here. Otherwise, you can be faced with that overseas tax charge for not being residing in the same country as the QROPS. But yes, as a general rule, typically it can be more tax effective for yourself. However, that is going to be specific to the client's circumstances. For instance, if your intentions aren't to remain here in Australia for the foreseeable future, then there can certainly be penalties the other way in terms of conducting that transfer and restrictions about you sending the money back to whichever country you may be moving to from there. So I would like to just caveat that general rule comment at the beginning.
Thank you, Dan. One final question has just come in here. Billy, again, this one's quite difficult to answer, but I'll shoot it over to you. So what is the cost of the service?
Look, again, it's going to be specific for the individual. What I would say is please get in touch. We're more than happy to discuss it as a one-to-one basis. As Steph mentioned at the start, this is more of a general overview of the process. Specifics like that, feel free, as Dan mentioned, the initial call will be free. So please get in touch and we can discuss costs and whatnot in a bit more detail.
Perfect, thanks for that. Okay, well, that is the end of our questions. One final question's coming here, so we'll answer this one and then we'll close down the webinar. So Dan, can you transfer an Aesf to an Smsf?
Yes, you can transfer your funds from Aesf to an Smsf, but obviously do note that if you are still within the member payment provision periods, then that Smsf does need to be a QROPS Smsf, otherwise you would be faced with those penalty charges.
Perfect, thank you for that. Okay, well, I think we'll leave it there. I think we have answered all of the questions, but we will review them after the webinar and get back to anyone individually if we have missed any out. So I hope everyone attending found today's webinar useful. And thanks again to John for being our guest speaker. It was really good to have you on. And yeah, look forward to working with you going forward on some cases. So yeah, thanks everyone. And I'll close down the webinar now. Thank you.